Very good evening. You're watching the India Development Debate. I'm Tamanna Inamdar speaking to you on a day of fast-paced action after the RBI capped withdrawals from Yes Bank to 50,000 rupees per depositor for at least a month just about 24 hours ago. The bank has been hunting for an investor for over a year, remember, and has been bogged down by bad loans. Finally, the RBI had to step in. So here's what happened today. Serpentine queues outside branches with depositors waiting to withdraw their money. The RBI putting out a draft plan that sees State Bank of India take a 49% stake in the beleaguered bank. And meanwhile, Finance Minister Nirmala Sitharaman assuring depositors that their money is safe, also taking the opportunity to blame the yes mess on the UPA. As we wait for more clarity to emerge on how exactly Yes Bank will be rescued, it's important to ask a few key questions. Despite warning signs, and they've been around for long, why was there no action before? Did we really have to wait this long? Why should depositors always bear the brunt of poor decisions that a few key people make, whether it's giving loans to the wrong people, whether it's putting out information that is incorrect? It's the depositors who bear the brunt. Why this mess in Yes Bank even after an RBI appointee on the board for nearly a year, since May 2019? Also, why were lofty claims of now what seems to be imaginary investors allowed for so long from the Yes Bank management? Why were rating agencies giving pretty decent ratings to the bank until recently, when we know that now this could have been a long-standing problem? Should retail investor risk have been restricted earlier? There was no action on removing this script from the Nifty for very, very long. So before we begin the debate on all of these points, let me get a take from ET Now Managing Editor Nikunj Dalmia. Nikunj, isn't it time to ask if there was a systemic failure in identifying the yes mess earlier?
Tamanna, we can endlessly talk about why Yes Bank as a franchise has collapsed and why check and balances were ignored. But the moment right now is not about the blame game. It is not about taking the clock back. It is understanding where we stand. And since Yes Bank as a franchise had collapsed, and if Yes Bank was not rescued, it could have a contagion impact on the Indian financial system. Yes Bank has a very large liability book of nearly 2 lakh crore. And if there would have been a run on the bank, I don't think Indian financial system right now can really bear the brunt of that. So morally, we can argue, but is this a need of the hour? Of course, this is the need of the hour. Now, stock markets on Thursday knew this was coming, and by Friday afternoon, the stock prices of Yes Bank and other banking stocks and also Yes Bank had acted and reacted. So from a market standpoint, the new thing is that Yes Bank and SBI will remain independent. Yes Bank and SBI will not be merged. SBI will be treating Yes Bank as an investment. They'll have to pump in capital, and that's not a large capital they will have to pump in. So the way I look at this is that this is a rescue operation, more like a surgical strike, and this surgical strike surely will prevent or stem the collapse of the Indian financial system. Now for SBI shareholders, it's not, of course, the rescue has not been done in the right spirit, but if SBI is able to really turn the franchise around, you never know. On a 1-year basis, on a 2-year basis, on a 3-year basis, they may just end up making money. Yes Bank has a formidable branch network. It has a decent technology platform. It also has a huge advantage of fee-based income, which none of the other PSU banks currently have. Now you may argue back and say that, look, banking is all about trust, and when the moratorium lifts, Yes Bank will see a run on the bank. It may happen. So Yes Bank may not be as strong, as formidable as what it was at its peak, but surely from a market standpoint, it's a hangover which is over.
All right, that is the market standpoint, but we're going to go beyond that on the show this evening, because, one has to ask what really is going on in the Indian financial system. Even as we look at the rescue plan which has been put forward, this is open for people to comment on. That's what the Reserve Bank of India said while putting forward that rescue plan. And, inputs will be coming in. We also know that the State Bank of India will be coming out with more details later on. But meanwhile, to look at the larger picture, I'm joined this evening by Maithili Bhusnumat, consulting editor, ET Now, D.K. Mittal, former banking secretary, and Professor Sachin Chaturvedi, economist and policy researcher, and of course, board member of the RBI. Welcome to all of you, and thank you so much for joining us. Mr. Chaturvedi, let me come to you first straight away on the role of the regulator through all of this. Now, we know that the regulator has been in the loop very much on what's happening with Yes Bank. That actually pushed the change in management almost a year and a half ago. Do you think the lease of life or the rope given was too long? Did we have to wait till now? Because for the last few times, the tales of investors began to sound quite strange to anyone who would hear it. You know, the imaginary investors who were going to come in and rescue the bank.
Anamika, if you look at the amount of trust that that is there in the Yes Bank's working, the amount of nudging that the Reserve Bank of India has done in last 1 year, and I would say effectively from July 2019 onwards, when several issues started cropping up, and by February 12th, you find that still the Yes Bank management was misleading on several fronts, which RBI could detect, and we could initiate a dialogue with them. So I think the Reserve Bank of India has tried to arrive on a solution which is led by the management of the bank rather than RBI directly intervening. But when 2012 efforts that were made in terms of reducing the promoters' interest, I think it's also an important issue for us to see how much interest the promoters have in the overall canvas. And if you look at 2019 July and then 2020 February 12th meeting, when the idea was to bring accountability back there, the subsequent developments from 12th February onwards till this action has been initiated, you would see that the caution that was required, the professional handling that was needed, Reserve Bank of India has, in my view, has managed the situation in a way that could have given better results to us. The question can always be in the hindsight in terms of when actually they should have intervened, yes, and when they should have taken over. When the parameters, and if you see even the two submissions that are there by the bank, both on in March and subsequently I see in September 2019 the exposure of the bank to bad debt, as it is called, is fairly balanced. So you do not get any reason to apprehend the situation.
So then what changed?
Subsequently from July onwards,
Mr. Chaturvedi?
One is getting exposed to,
yes,
several of the vulnerabilities.
Yeah, so my twofold question. If you're saying till September 2019 it wasn't that bad, and then we've also had an appointee of the RBI on the board since about May 2019. So what has changed then? What has changed since then? And that is why the question is being asked today about whether action could have been taken earlier. Did we have to come to this point where a moratorium had to be put in place?
See, if you... Yeah, so what has happened between March 2019 and September 2019, if you look at the sort of going up of the bad debt and the amount of exposure that is there in terms of NPA creation, within this period you suddenly find a huge jump in the NPA that the bank has come up with, which is completely sort of misleading in terms of the numbers. The jump is as high as 154.5%. So this huge jump is absolutely shocking, and that's where in February the RBI had to intervene and put in a more professional approach of getting in the experts that were required to look into the books.
You know, that's the strange part. I saw Mr. Mittal's hand go up there, and he wants to come in on the show. It's not like this bank has not been under scrutiny and action hasn't been taken earlier. You had a whole situation where, you know, the promoter and end all and be all of the bank was nudged out and pushed out by the Reserve Bank. Then a new guy comes in, he's been given some time, and then it all seems to escalate very quickly. What, in your view, has really gone down, Mr. Mittal?
See, RBI is a very patient and persuasive regulator. With digitization coming in the economy, I think bankers have become very smart. So it is a food for thought for RBI to see that whether their method of supervision is sufficient to deal with these smart bankers. Perhaps there is a need to look at inwardly. But then let me say that after what has happened, one can always say today that it could have been done 1 year before, 2 years before, that's a judgmental call. But what has been done since yesterday, today, we must compliment RBI and government for coming up with the rehabilitation scheme or the reconstruction scheme, which I think is a fairly smart move. Ideally, it should have come yesterday, then the massacre which happened in the market should not have happened today. But even then, it's much better that it has come today. So I would say that there is a need for RBI to have inward looking to see that how they deal with bankers much more smartly than what they have been doing so far. That there is a strong case for that.
Maithili, I want to get your take on some of the questions that we posed in the beginning of the show. Because now in hindsight, it seems like this was coming. But even 2 weeks ago, Yes Bank was still in that, something may happen to rescue it kind of a situation. Do you think this could have been handled better? And also the bigger question that the layperson is asking today, does it point to a larger systemic problem?
Well, let me answer your second question first, Tamanna. I don't think it points to a larger systemic issue. This is a specific case relating only to Yes Bank. But yes, I think it could have certainly been managed better because the moratorium was completely unexpected. It was well known that Yes Bank was not in good financial health. But as Mr. Chaturvedi said, as on March 19th, the bank had a positive net worth. That means the total of its paid up capital plus free reserves was greater than its outside liabilities. So the bank was in a position to pay all its depositors. So what explains the sharp deterioration between March 19th and March this year is little inexplicable because the net positive net worth is as much as 25,000 crores. So even if there was a sharp jump in the non-performing assets, was the picture so dramatically different? Did the RBI have to bring the bank under moratorium? Could it have been managed better? Was the RBI lacking in its supervisory abilities? I would think that is partly the reason, because if you see, it is not just Yes Bank. Before that, we saw PMC, we saw ILFS, questions were raised in the case of Axis, in the case of ICICI Bank. So clearly, RBI has some answering to do as far as its supervision is concerned. Why did the bank allow Yes Bank to get to this sorry pass? Why was nothing done a little earlier? Having said that, yes, as Nikunj said, there's no point getting into a blame game, but we do need to examine how do we beef up the supervision. As far as the rescue itself is concerned, I have a problem with asking State Bank of India to take a 49% stake in Yes Bank, simply because State Bank is not just a government-owned bank, it also has retail shareholders. It is a listed bank. So if you do this to the private shareholders or minority shareholders, particularly at a time when the government is hoping to disinvest in public sector units, then will anybody be willing to buy into public sector units? If not in public sector banks, at the moment we're not disinvesting there, but the moment you feel that minority shareholders are always going to be roped in willy-nilly, whether they like it or not, that sets a very bad example, very bad precedent. So I have a problem with the manner it was done. Was moratorium the best way, or could a special package have been carved out for Yes Bank? Because if in the early 90s, Indian Bank, which was of course a government-owned bank, the net worth turned negative, and yet there was no run, precisely because there was some trust in the bank.
Yeah.
So Yes Bank had trust. People had trust in Yes Bank, regardless of its financial position, because the ordinary depositor is not aware of the financial position.
You know,
So I think
exactly.
the entire situation could have been managed better, and I think we need to take some lessons from that.
No, so Maithili, that's an important point. The moratorium is procedural, and it's supposed to be to protect depositors, but it actually ends up panicking people even more because you're not very clear when it will lift.
Absolutely.
Yeah, you know, just speaking about the role
Yes.
of
and particularly if the RBI already had a restructuring program in
no, continue your point. Yes.
when the RBI already had a draft restructuring program, could it not have come out with this a little faster?
Absolutely.
It could have announced a moratorium and also put out the restructuring program, in which case there would not have been this kind of panic.
Everyone was reporting some contours of the restructuring program as of yesterday. Now, we know that the State Bank of India will have a press conference tomorrow. We're not sure, but the RBI also may have a press conference tomorrow. All of this could have been cleared and put out very quickly to, you know, not have depositors hold the can. Meanwhile, just on State Bank of India, since you mentioned that, and this is something someone very senior in banking circles sent me, saying that the joke going around is SBI will be called now as the Saving Bank of India. That really is a concern, because will SBI keep coming in? Some of the questions that Maithili raised, Mr. Chaturvedi, I'd like you to respond to them. In terms of the role of the RBI and also your take on the moratorium. I know you will say this is procedural, this is technical, they have nothing to fear, but put yourself in place of the person who has this cap and limit, you know, in the first week of the month.
Yeah.
And is figuring out now,
No,
you know,
I think
how to make payments. If it's their salary
think,
account,
Tamanna,
get another account. It's not fair.
No, I think Tamanna, both Maithili and also Mr. Mittal have raised some very pertinent points, which, as Mr. Mittal very rightly said, would have to be seen as we are moving along. And immediately after the PMC crisis, the governor had stated in terms of how they are going to leverage modern technological tools that are needed for such situations. But I think the point that you made in terms of RBI being in touch with imaginary investors, I think is not correct. If you look at
I said,
the 12th February,
no, RBI was not. That's not what I said, Mr.
press
Chaturvedi.
release
Let me make.
that
That's not what
RBI
I'm
came
saying.
out
Let me
with,
make very clear what I'm saying. I'm talking about the quote-unquote imaginary investors that the Yes Bank management was touting. In this, I will also include sort of media leaks, and I'll say this very openly today. Media leaks coming in from XYZ investors all the time. Whether it was a Mr. Bright, who no one knows whether, you know, he was even interested, where he existed, or other names which kept swirling around and kept moving the stock. The fact is that it was a right rotten mess. I'm talking about that. I'm not saying the RBI talked to imaginary investors. I'm
Good.
talking about
So
the imaginary investors
I'm glad
that
you
the Yes
clarified,
Bank
because-
board was talking about.
because
We
I
let
think
that
it's-
go on.
I agree with you. Good that you explained it. I think it is also pertinent for us to see here what kind of streamlining is required within the system, and of course the way RBI has been managing some of these challenges which are emanating out of the system that is there. But I think given the fact that at this point there is a panic, at this point the investors are worried, at this point the depositors are worried, I think Nikunj was absolutely right that we first need to tackle this, get it on ground, and see how RBI in future would respond to some of these challenges.
No, that's true, but we also have to ask the tough questions over here. And D.K. Mittal, I want you to come in, because in this list I've also talked about credit rating agencies. Remember, Yes Bank didn't pop up today. The fact that a lot of its loan book is you know, to companies that aren't able to repay is not a new problem. Yes, Mr. Chaturvedi.
Tamanna, I would have to seek your permission to move out now at this point.
Yeah.
I
yeah,
have
okay.
another commitment.
Okay, no problem. Yeah, Mr. Mittal. Yeah. So the point I was making, these problems did not crop up overnight. Clearly, in fact, you have a situation where the ruling party and the opposition are now saying that the pain started in your tenure and the pain started in your tenure. I don't know how relevant that is. The fact is that the depositors, shareholders, etc., are left carrying the can. But it's not a new problem, which is why it's important to understand what our scrutiny is, what our scrutiny measures are. We asked this about PMC. PMC is not under the direct supervision of the RBI. That was the problem that was, identified. But that's not the case in Yes Bank.
So I said earlier, there is a need to improve supervision practices by the RBI, and that I think is well realized in RBI. The fact remains that rating agencies have never come out with great merit. While the whole world, the whole lenders all across the world, they depend on rating agencies. This is so unfortunate. Please remember, in 2008, all the European countries which ultimately became junk were rated AAA plus, higher than India. So that is the role of rating agency across. And unfortunately, they never get punished for these failures. They always have an LB to say that we did not look at this data, this was not our role. So all that they will find some reason. But the fact remains that I fully agree with you that the rating agency's role is very, very questionable, and that comes under the supervision of SEBI, which what I'm aware is that it's seized of this issue itself. But the second question remains that what RBI can do, and I fully agree on this point, there is a distance to be travelled by RBI. This country cannot afford failures of PMC, Yes Bank, ILFS. It's not acceptable to the country. It is not in the best interest of the country to have any such failure. And if we anticipate any such failure, a preemptive action, a preemptive strike is the best thing to do. So that saves the integrity of the financial system and also reputation of the country, which is of paramount importance. Reputation of country should not be put at stake for any reason. So when we say my banks are failing, global financial investors as well as institutions, they look at us very poorly, which should not be the case.
Well, the fact is that Yes Bank has had a very interesting history. Its problems have not cropped up today. Maybe they got worse in the last 1 year. Maybe it was, aided by the overall economic downturn. The NPA problem is across the board. It's not just in one bank. Many issues. And while we look forward, it's also important to understand the context of what's going on. That is key to get the full picture. So while I thank Maithili and DK Mittal and of course Mr. Chaturvedi for joining us on the show, I just want to take you through the journey. And this is interesting because the promoter founder of Yes Bank, Rana Kapoor, famously once called his share and his stake in the bank as diamonds. He eventually had to sell them. Those diamonds are today worth dust. Here's how it happened.
Diamonds are supposed to be forever, right? Well, that's not true, is it? Ask Rana Kapoor, who on 28 September 2018 tweeted that diamonds are forever. My promoter's shares at Yes Bank are invaluable to me. This was when Rana Kapoor was told to leave the managing director's post at Yes Bank by the banking regulator. Little did he know then that the bank will lose its way after his exit and turn those diamonds into dust. Now let's take a look at how the bank reached here. From inception, there were issues with how Rana Kapoor ran the company. It started with his spat with a fellow promoter, Harkirat Singh. The word about Yes Bank in financial circles was that it was a lender which never said no to risky borrowers. The bank grew exceptionally when the veteran banker used his networking ability to lend and recover loans. As a result, Yes Bank had a big exposure in the infrastructure sector and the telecom sector, the two sectors which have seen a structural slowdown, resulting in many companies going bust. Irrespective of this growth, which made the bank a cynosure of investor eyes, examples of poor governance were present all time along. But the real worry started when the RBI started reporting divergence in the asset quality review. Yes Bank's divergence was a whopping 6,355 crore rupees in bad loans. The lender further reported divergence last year And with the new management at the helm after Rana Kapoor left the bank, Ravneet Gill announced a mega plan of raising around $2 billion, and like many times before, the fundraising plans went bust. Now the big question is that whether the bank has gone insolvent. Is it why that the RBI has placed restrictions on the depositors' money? The GNPAs have risen to 7.39% by the second quarter of FY20, and the bank is yet to declare its third quarter numbers. The RBI has now put in a draft proposal for Yes Bank's resolution, but for now it is the depositors who are the ones bearing the brunt of perhaps saying yes to everything.